decades, which simply enough was just one of debt growth exceeding income growth. This seems to be what Bernanke, ECB, Bank of Jamaica, everybody's trying to preserve the system, but I think anybody with a sixth grade math skill and a calculator can tell you that that game ends sooner or later. Does the Fed lack sixth grade math skills, or what's their end game here? I don't even understand how this game plays out. Sooner or later, you have to get your debt back in line with your income, period.
Right. Well, when you have this much debt overhang, and I think you've described the problem correctly, Chris, there are only three ways out. The first way out is default, and we're seeing that in Greece today. The second way out is inflation, and this is the preferred method of the Fed and the Treasury. Now, you'll never hear a Fed chairman say, we're working really hard to get some inflation into the system, although, interestingly, Bernanke has said some things very recently that were very revealing along those lines. He said, we don't want too much, but he's very candid about targeting 2% inflation, and has gone on to say, we might overshoot the target a little bit, or things might get a little bit out of control. We could have something higher. To me, that's revealing because there's no doubt that what they're really shooting for is 4% inflation. They want the shock factor. In other words, they want to guide your expectations to 2, then actually produce 4, so that people will sit up and take notice and say, gee, I better do one of two things. I better go out and buy that car, buy that refrigerator before prices get out of control, or buy that new house, just to prop up asset values. The other thing is that at that point you'll have steeply negative real interest rates, meaning if the nominal rate on the loan is 1%, but inflation is 4%, then the real cost of borrowing is -3. The lender's paying you to borrow. You can pay them back in cheaper dollars. I like to say it's like renting a car and driving around and returning it with the gas tank half empty, but not having to pay for the gas. So that's what the Fed's trying to do. They're trying to get that lending and spending machine going again, get the velocity of money up, and kind of inflate their way out of this problem. A couple problems with that. Number one, 2% inflation is not so benign. 2% inflation cuts the value of the dollar in half. Cuts the value of the dollar by 75% in the course of a typical lifetime. So it cuts it in half in 35 years, and then in the following 35 years cuts it in half again. So now you're down 75% from where you started. So from the time you're born to the time you die, your dollar's going to lose 75% of its value. That's in 2% inflation. In 4% inflation, it'll cut the value of the dollar in half by the time your children go to college. So these are cancerous rates of inflation. They're not. The 2% sounds warm and fuzzy. It's not. The other thing economists say is, who worries about inflation because your wages are going up and it all comes out in the wash? Well, I mean, it's this kind of thing that only an economist could say. The fact is, some of it does come out in the wash on average, but we don't live on average. We live our individual experiences. And the fact is, in inflation, there are winners and there are losers. The winners are people who can see it coming, who understand what you and I and hopefully the listeners are talking about, and hedge their position by getting gold or silver or land or fine art or investing in railroads, as Warren Buffett did, or doing some kind of hard asset play. The losers, those are savers, people with insurance policies, annuities, pensions, retirement plans, anything denominated in dollars that are not going to go up when the inflation kicks in. So inflation is really a form of theft, taking from everyday Americans and giving to elites, hedge funds, bankers, and other people who understand, again, what we're talking about. So these are not benign numbers, but they do reveal the Fed's hand. The Fed is out to inflate away the debt. The third way out, in addition to default and inflation, is growth. I mean, what happened to growth? And the neo-Keynesian economists like to talk about the trade-off between consumption, which is just individual spending, and government spending. They have this concept of aggregate demand, where they say, well, gee, aggregate demand is falling short of target, like we're not spending enough money, and consumers won't step up. So government has to step up and fill the gap between what consumers are doing and the theoretical aggregate demand. Well, whatever happened to investment? I mean, investment is part of GDP. The economists act as if consumption and government spending were the only two things that mattered. And of course, net exports is another part of it, but that's where the currency wars come in. But what about investment? Investment is doubly beneficial. When you spend it, you get GDP immediately, and then if it's productive, you get improved productivity and GDP down the road. So it's kind of a twofer. So we got to move from a consumption-driven economy to an investment-driven economy, but instead the neo-Keynesians just want to substitute government spending for individual spending, and that's just part of this road to Rome.
Well, I think part of their flaw, as I see, is they were expecting that a couple of $1 trillion poured into the gas tank would have got us revved up and moving, and it hasn't. And one explanation for that is when I check out an oil chart, I can find exactly 0 historical examples of a recovery happening at the inflation-adjusted equivalent of $100 per barrel oil.
Right.
Do you have any thoughts on peak oil or energy prices and how those factor into this pile of debt?
Well, certainly high energy prices are going to impede the recovery, and we're getting that not just from kind of the prospect of inflation, which we've talked about, but also because of geopolitical concerns in the Middle East, and I think those concerns are going to become more acute as the year goes on, and the price of oil will go higher. So I'm not really an expert on peak oil, but I am an expert on geopolitics, and I can see that driving the price of oil significantly higher. And again, the data is unquestionably what you described, which is that's not the foundation or the basis for recovery. So in addition to all the other headwinds I talked about, which is low money velocity, negative home equity, excess debt at the consumer level, deleveraging. In addition to all of that, we have this high price of oil, which is just another headwind. So again, it's all the more reason to think that the Fed's got their work cut out for them. But what concerns me is that instead of just sort of acquiescing to deflation and letting prices find their level, letting the housing market find its level to the point where people actually want to buy housing or buy stocks on fundamental reasons, instead they insist on propping up the asset bubbles through asset price inflation and ultimately consumer price inflation. That will end badly, but it's very hard to say when.
So let me back up then to where you said that, Bernanke said 2% is what we're targeting, wink, wink, but he wouldn't be unhappy with 4%. So they've already got interest rates at 0. They've already got as much liquidity in the system as I've ever seen. They've expanded their balance sheet by a factor of 3. They've done all these things, and we don't have a whole lot of inflation going on by official measures. Do we interpret that as another round of QE is on the way? And if so, when would you think that might happen, given politics or election cycles or anything else?
Sure. I think there are two interpretations, Chris, that are consistent with each other. I like to say it's a sad thing, a sad sight when the Fed is trying to get inflation and can't get it. So you're right. We haven't, despite printing over $2 trillion in the last 3 years, we haven't seen much inflation in the United States. But there are two reasons for that. Number one, there's a very, very powerful deflationary vector coming out of the fact that we're in a depression. I don't really think in terms of double dips and recession cycles. I think we're in a depression. I think it began in 2007. It's probably going to continue till 2014, perhaps longer, depending on policy. So there's a natural rate of deflation coming from that as balance sheets deleverage, assets are shed, prices get marked down, et cetera. But then there's inflation, which is induced by the Fed through policy. So what you have is sort of like two giant tectonic plates pushing against each other. It's the North Pacific plate pushing against the North American plate. Just because there's not an earthquake right now doesn't mean the tensions are not building up below the surface. I think the same thing is true when I see a CPI report coming in around 2%. What it tells me is that, deflation is probably, 5 or 6, and inflation is probably 7 or 8, and it may net out to 2, but the underlying forces are very powerful, and that could break one way or the other. So that's one reason. But the other reason is that until about a year ago, China was maintaining a peg to the dollar. What that meant is that as the Fed was printing more and more money, a lot of those dollars were finding their way to China in the form of direct foreign investment, portfolio investment, and China's net export account. And the People's Bank of China said to Chinese companies and others that you can't keep the dollars, you have to give them to us, and we'll give you our currency, the yuan, the Chinese yuan, in exchange, and then use that to pay your bills and your payrolls and all that. Well, what that meant was that the faster the Fed printed dollars, the faster the Chinese central bank had to print yuan to soak up the dollars. So the inflation actually broke out in China. Inflation took off with a vengeance in 2010, 2011, which is highly destabilizing and worrying to the Chinese leadership because traditionally it's a cause of political instability in China. So finally they threw in the towel and did allow their currency to appreciate, go up against the dollar. But that just means the inflation is now going to come back to the United States. Those chickens are going to come home to roost in the form of higher import prices. And this is the flip side of a currency war. Currency wars start because people want to cheapen the price of exports, but they forget that the United States imports more than it exports. So when you cheapen the currency, the price of all the things we buy from abroad, whether it's iPads, iPods, clothing, textiles,
petroleum,
European vacations, etc., all go up. So I think you can expect to see that inflation creeping in as a byproduct of the currency wars. But yes, we are going to see QE3. They're not going to call it QE3. They're going to call it nominal GDP targeting, which is a fancy way of saying we want nominal GDP to go up, and we don't care how much is inflation and how much is real. We just want the thing to go up because the debt is nominal. And you talked about fifth grade math. This is actually third grade math. 1 plus 4 equals 5, and 4 plus 1 equals 5. What the Fed is going to say is they care about the 5. They care about that nominal growth. If it's 1% inflation and 4% real, well, that's a very happy outcome. But they're saying if it happens to be 4% inflation and 1% real, we don't care. We have to get to the 5 one way or another. So that's a signal that the Fed doesn't care about inflation. They're just going to print as much money as they have to. And I think you'll see that probably at the April-May meeting, certainly before the summer. So, yes, that is on the way.
All right. In your book, you describe the end game as paper, gold, or chaos. Give our listeners a brief summary of what you think that end game looks like.
Paper would basically be substituting a new global reserve currency. This is sponsored by the IMF. It's called the SDR, which stands for Special Drawing Rights. And basically, people understand that the Fed has a printing press and they can print dollars. Well, the IMF has a printing press also. They can print SDRs and flood the world with liquidity that way, except there's even less accountability at the IMF level than there is at the Fed level. This will happen the next time we have an acute stage of the financial crisis, something like 2008. The Fed papered it over the last time, but the next time it's going to be too big for the Fed. The Fed increased their balance sheet to $3 trillion. What are they going to do the next time? Increase it to $9 trillion? I mean, there are political and practical limits to that, but the world has no limits because we can just print this new world money, global money called the SDRs, and it's nothing new. They've been around since 1969, and some of them were issued, a couple $100 billion were issued in 2009. So that'll be the new world money. Competing with that would be some kind of return to the gold standard where people do lose confidence in paper money, and the SDRs don't do the trick. It's just another form of printing. Countries may have to go to the gold standard, not because they want to, but because they have to restore confidence. The third possibility, chaos, is the one I think that's actually the most likely, not because anybody wants it or anyone plans for it, but because of human nature, denial, wishful thinking, delay, kicking the can down the road, that things just collapse. As we've said before, these catastrophic collapses in complex systems come out of nowhere. They happen very suddenly, and when you least expect it. I think that may be what happens here.
Yes, it's certainly, I love the description of the pressures are building, because that's what I see. I see that derivatives are actually higher today than they were in 2008. I see debt levels are actually higher, especially at the official or sovereign level. So these are all just pressures that are building. I can't find any historical examples. Maybe you know of one where a reserve currency has been on the path of trying to weaken itself. I'm not quite clear how that turns out, and I don't know if the world has a better view of how that's going to turn out either. So here we are, and today we've been talking with Jim Rickards, author of Currency Wars bestseller, The Making of the Next Global Economic Crisis. I highly recommend people read it. Jim, if people want to follow you further after they get your book, how would they do that?
Thanks, Chris. I have a very active Twitter feed. The account is at James G. Rickards, all one word. Rickards is Rickards. So you can just follow at James G. Rickards. You don't have to join Twitter yourself. You might want to, but you can just type in that handle, and my account will come up, and I put out quite a bit on the international monetary system. So that is one way to follow along, and I invite people to do that.
Excellent. Well, it's been a real pleasure talking with you today, and we'll certainly be tracking your book, how that does, and also what the Fed's going to do before summer.
Great. Thank you, Chris.
All right. My pleasure. Bye.
This concludes this podcast by Chris Martenson. To gain further insight into where things stand today and what might happen tomorrow, please visit chrismartenson.com. That's ChrisMartenson.com. Please join Chris Martenson next time to continue your journey toward awareness, understanding, and action.